Anzo Costanzo podcast. How are you out there? This is part 7 of the fall 2023 series of videos. And let's get right to there's a new assignment posted. So let's get right to it. Okay. I'm actually this time through, we all have a similar, it's asset bubbles. So it says posted, please start. So regardless of if you're in the afternoon, the morning, the graduate course, because it's that important. So actually, if you look at we'll go to the assignment in a second, but there's 2 videos here. This is part 1 and part 3. These are already listed. Okay, you should have been watching these videos already. Okay, these are down here. See, here's part 1 and here's part 3, and we talk about Grantham and asset bubbles. And there's a little more here, some of the questions if you want to spill over into 4, but basically all the questions are in number 3 actually. But watch the both of them, and the link is here. And again, there's no Excel with this, but there'll be Excel. We have to do some Excel. Okay, I'm trying to ease you guys into formats and cover pages and how to post something and all those kinds of things. You can see when it's due. It's due on the 9th, but up until the 13th to give you guys some time. So what you should do is shoot for the 7th, okay, and not shoot for the 15th of October. You can't work like that. You got to work. Being on time is being 5 minutes early. That's being on time, okay. And so many of you don't do that with anything, with your assignments or whatever. You got to shake all that high school stuff off, and you got to get serious about what's going on. Okay, here's some of the questions. Yeah, and you should, folks, and you should watch this on like a laptop or a tower computer. People say, "Oh, I'm on my phone walking down JFK trying to watch the class or something." It's not really made for that. Okay, you can't really do it like that. Okay, you got to sit in front of a computer or a laptop in the library, get headphones, something like that. Okay. State the 3 bubbles referred to below and characterize each. You need a good half a page each on these. This is in terms of time. Okay, it's, the 08 and the 1929 one and all that kind of thing. Time wise, in terms of history, so from a time series perspective, how can bubbles lead to recessions? Talk about supply, demand, and price. So for the 101 class, that's important. For the 415, here's the China current economic issues. All right, so that's a little bit of the international is in there. And anytime you talk about inflation, interest rates, that's corporate finance, and then the impact and the cost of borrowing, real estate prices, growth focused stocks. That's also corporate finance. So we hit the different areas with the same material, and we've done that for a very long time and been successful at it. I clear out all the highlighting just to make you guys read this. I hope. Supply. Yeah, I left the supply and demand stuff in there, but it's outside of that. So yeah, the 20 stock bubble, the Great Depression, that stuff. And then there's Jeremy Grantham has some of his opinions on things. But folks, this is a very nice reading of what's going on right now. And you have the video, so I threw this up there. So we have a good piece of our assignments already posted. So you have the return on equity assignment, you have the bubble, the macro classes. You guys have the definitions. Okay, so that's where that is. And with a link to assignment 2, I like these links. I eventually started doing these. Okay. And I posted, if you guys look at your emails here, for the 401 and the 410, we're only meeting Thursday this week. We're not meeting Wednesday because of the mass, and Monday's our YouTube day. Okay. Same thing for 410. For 415 and 101, we'll meet the Wednesday and the Thursday. Okay. And the 622, we only have 4 more sessions. The 4th, the 18th, November 1st. Okay, so check out what you have in terms of the schedule, and everything's posted to Blackboard that we're doing. Okay, please. Okay. Okay, so what we're doing here today, let's get to it. Okay, so we stopped here. I guess in part 6 we stopped here at advantages of this was I like this as a good place to sort of begin and end, and we'll hit this. Historical evidence suggests that the focus on dividends may amplify returns rather than slow them down. I've never heard of Hartford funds, but they're probably, again, since the 70s, they're probably right. If you look them up, I'm sure you might see some version of that. But those outside of Warren Buffett, any kind of asset management stuff, once they make their money, they're back in Connecticut or back up in Massachusetts or California, wherever they're from. But it says 84% of the returns are from the S&P 500 or from dividends. It's based on the fact that investors are likely to reinvest their dividends back in the S&P 500, which then compounds our ability to earn more dividends in the future. Okay, so that's pretty much that. If you invest 10,000, yeah, this one, we had this in class, and I don't know, for better or worse, I didn't really go through it, but here we're gonna mess with it right now. Okay, and I'm taking kind of a little bit of a chance here because I really didn't work this out sort of previously, but I don't like to just do things from the seat of my pants, but we're gonna do a little seat of my pants right now. So just hold on while we do this. Okay, so hang on there. Here we go. All right, we could work down here someplace. And we might not get this right, so just stand by. Stock yield of 4% on a $100 share price. Okay, we got that. 100 shares, dividend $4 a share, and paid dividend of. So we've got all the math condensed over there. To purchase 4 more shares. Okay, that's the assumption, is purchasing 4 more shares. And so you got to break it up into pieces. Okay, I will do all our math in Excel. So let's just pile this here for a second. All right, what are we doing? It says, for example, okay, you're starting with what? You're starting with, and we're just going to jam stuff in here, and then we'll clean this up in a bit. And maybe it's good we do it like this. Are you starting with $10,000 and a yield of 4%? And so this is capital. Per share. Okay. And what are we going to do here? So this is equal to, you spend 10,000 on 100. So you have 100 shares, center it. This is a number, no decimal places, and leave the font as is. And this is number of shares. Number of shares. Okay. 100 shares, and they all pay dividends. So dividends paid per share. Okay, and it's $4 per share. And you have 100 shares, so copy, and this is down. This is total dividends paid. Right there. Negative. There we go. Okay, so you're paying $400 in dividends, and the yield There should be see, and again, I don't usually go. Usually, it's all already set up. So maybe it's good we're doing it like this, so you guys can see how everything unfolds. Here's the yield is 4%. Okay, we have that. So see that's how you turn the thing into Excel, right? You break up the in your mind's eye. You got to break it down, break it down, break it down. Is what you're doing. All right, so we're putting everything in Excel here, and it says assume the investor uses the 400. So yeah, dividends to purchase 4 more shares. Okay, so now 4 more shares purchased. And here's where it gets okay. So they're going to buy. They can buy 4 more shares, and adjusted X dividends. So yeah, so actually, so maybe on the so what happens? The date the dividends are, yeah, the date the dividends are paid. Yeah, the date the dividends are paid. The price is adjust. It's a purchase 4 more shares. This thing right there. Like that. All right. So 4 more shares are purchased. And date is there. And yeah, so equals 400 divided by parentheses 100 minus the 4. There it is. There's your 416 or whatever it was. Oh, yeah. Okay. So see how this worked? That's how they got the 416. They said, okay, you're going to do the dividends are paid, and now the share price is no longer 100; it's 96 because you're doing X. So in other words, you're on the date of the dividends are issued, you're going to get the benefit of the dividend. So you're paying 96 a share. So in other words, you bought 4.16, 4 and a fraction of another share. Dividend reinvestment allow for fraction share purchases. If nothing else changes the next year, the investor will have exactly. We'll have that in terms of share. So next year for next year. No changes. What are you going to have? You're going to have copy. And this is simply, equals that plus the 4 and a fractional. There's, yeah. And what's that going to be worth? And same share price. Is this so? Value of all shares held equals this thing times stock price. Yeah, there it is. In class, we were bumbling with this a bit, but there you go. Okay, you start with $10,000 and see, and this was good. We worked this out in Excel. All right, you start with that much capital and a certain stock price, and you had a number of shares that you bought. Okay, so you had 400. So you had 100 shares times $100 stock price is 10,000. Your portfolio value at T0. Right, this is T equals 0. Text. Boom. All that. Italics even. Okay. That's at T0. And this is end of T equals 2. Okay. Italics, make it smaller. There we go. End of the second year. So you want your numbers in good shape here. And here, this would be at T equals 1. Okay. There's your model. So we took this little, what was going on here, figured out where the 4.16 came from, figured out where the 10,416 came from. In class, I bungled this. I remember that I bungled this in class. I apologize for that. Okay, that was good. That was good. We did all that. Okay. So these are advantages of dividend yields, and and again, what are dividends? Dividends are a portion of the earnings. Well, high dividends are attractive. They may be at the expense of potential growth of the company. Yeah, so you got to be careful if you need the capital for reinvestment and research and things of that nature and expanding the company. Okay, if you're constantly paying out dividends from day one, right? That might be a problem. That might be a problem. You got to be careful with this. All right, is a job that the company is not reinvesting. Yeah, to grow and generate more capital gains, even without earning any dividends. The shareholders have potential to earn higher returns if the value of the stock increases. Well, yeah. So again, and really, companies. It's a rare bird. A company like Apple that went through a real valley. I'll tell you, I haven't read the entire story from like the 80s into the 90s, into the 2000s, and so on. But that must be a really tremendous story. I'd really advise you. I'm sure there's lots of books written about it and Steve Jobs, but read the history of Apple. And I probably have some books tucked away somewhere, but I read the history of that company. I think it'd be very instructive and very useful to your career to understand what happened there. Because it sort of dipped and then came back, and then now it's come back with a vengeance. And now Warren Buffett owns like 25% of it. And so he put his money on the right thing is what he did. So, and certainly you're not evaluating a company. I don't want to say stock. What does that mean? Like Buffett said, the ticker symbol. Yeah, I wouldn't analyze a company based on a dividend yield alone. And you want to look at earnings, and you want to be careful of separating yourself too much from the financial statements with too many ratios and too many percentages and too many fancy bells and whistles. You got to look at fundamentally how the company operates. Okay, that's that. And people like to sound smart and say, "Oh, this ratio and the cash flow analysis and whatever." But you got to look at the financial statements. Everything starts there. The dividend data could be old, or there could be errors and things of that nature. You got to be careful with that. A very high yield as their stock is falling. Sure, you could have a high dividend yield with the stock is falling. Remember in class where the dividend yield declined for Coca-Cola and American Express, and we might sit there and say, "Hey, professor, time out. There's something wrong here. This percentage is getting smaller, right? Isn't that bad?" Well, because again, we're so trained. Bigger numbers. Bigger numbers are better, right? Always more, right? We're trained to think that way, but you got to be careful with the ratios and what you're looking at. Okay. So again, if the stock price happens to be falling, but it just happens to pay out lots of its earnings or give a good payout, then deceptively, and if you have like a very unusual reading up or down with the yields, that warrants further investigation as to why that is. Right? If there's enough decline, the amount of dividend could be again. If you have a company that's in trouble, They need the cash for our defense. Right? Remember The Secret of My Success? That movie from the mid 80s, that was the answer to the Wall Street movies that were very serious. That was like a little bit of a lighter version of working in New York. It wasn't so much it was a conglomerate. The Wall Street Never Sleeps guys, that was a brokerage, and they were buying Teldar paper or whatever, something like that, right? It was the hardcore, Wolf of Wall Street type of a company, the brokerage industry, as opposed to just The Secret of My Success with Michael J. Fox. That was just a conglomerate. He was coming from Kansas, and he was going to work for the company, believed in the company, and all this other stuff. So anyhow, investors should exercise caution when evaluating a company that looks distressed or has a higher than average dividend yield. The stock price is in the denominator of the dividend yield equation. A strong downward trend can increase the quotient of the So you got to know your numerators and denominators. If the bottom is just getting too small, it's going to artificially inflate that ratio, and that may not be good news. General Electric was underperforming, or had a different division that were underperforming. The stock price fell as earnings declined, and the yield jumped from 3% to 5%. But as the value, the market value of the equity also declined. So as you can see in the following chart, of the decline in the share price and eventual cut to dividend offset any benefit of the higher dividend yield. So there's some chart somewhere, and you guys can look up General Electric and how it did, whatever that was 7 years ago. The yield versus the payout ratio. So I should be sending this overseas, the part of this lecture, right? When comparing and measuring corporate dividends, it's important to note that the dividend yield tells you what the simple rate of return is in the form of cash dividends to the shareholders. However, the payout ratio is how much the earnings are paid out as dividends. Okay. While the dividend yield is the more commonly used term, many believe the dividend payout ratio is a better indicator of the company's ability to distribute dividends consistently in the future. The dividend payout ratio is highly connected to a company's cash flow. Sure. Okay, so again, in other words, if you're paying out parts of your earnings, you're able to do it, and the more of that you do can signal either that you don't need to develop your company currently as much, or maybe you're on the down cycle of the business life of the industry. It could be that. You hope it's not, right? You're always figuring out, like again, Apple and even IBM to a point, sort of reinventing themselves, all the time. But that's a tough trick to figure out, because people have to have motivation to do things and all that kind of thing. The yield shows how much companies paid out dividends over the course of a year. It's presented as a percentage, not as actual dollar amount. Although certainly you can, we like to know how much dividends are paid out, and we can do the math in our head on it with a spreadsheet ourselves. It makes it easier to see how much the shareholders can expect to receive per dollar they've invested. And again, this whole shareholder idea, we look at a company who owns it. Okay, the whole share. That's another facade. That shares exist to allow everyday people to participate in capitalism, is really what it's for. Okay, the real equity financing is done. The real equity financing is done by deep-pocketed folks. And actually, I'm just reminding myself what video number 8 is supposed to look like. Financing. Okay. We'll get to that. There's some examples. A company's stock has a $20 share price. It pays the dividend $1 per share. And the B is trading at 40 and pays a dividend also $1 per share. So A's yield is 5% and B's yield is 2.5%. But which company is more valuable? Again, obviously, company B has a higher share price, so the yield might be a bit lower, and it is. So even though there's a lower yield, but the value of the equity to the open market is greater by twice. Yeah, so folks, you need capital to make playing in the stock market worth it. Okay, you need capital to be able to do that. All right, there's a couple. Oh, good. So we moved through this pretty well. There's a couple questions here. What does the dividend yield tell you? It's a financial ratio. It tells you the percentage of a company's share price. It pays out in dividends each year. For example, if a company has $20 share price and pays out a dividend of $1 per year, the dividend yield will be 5%. The yield has been steadily increasing. Could be because they're increasing the dividends and the share price is declining, or both, depending on the circumstances. So, yeah, look, I think with Buffett, we determined that the value of his equity increased at a bigger percentage. There was a bigger growth rate for the value of the equity as opposed to the growth rate for the dividend payments. So if the growth rate in the denominator is larger, that's going to get, the denominator will get bigger faster. And that ratio is going to go down. It did for Coca-Cola, it did for American Express. Why is it important? Dividend yields, dividends are parts of income, and some companies pay a lot of the income, the earnings out. Okay, so it can have a big impact on your on your performance. Okay, so and it's this talks about portfolios and younger investors. I'm not really, I don't play that game, so I don't really talk about it. But is a high dividend yield good? Generally, I mean, you want to look at the dividend yield comparable to other companies in that industry. Okay, and if your dividend yield is very high, you want to examine the earnings performance. You want to examine the dividend payment performance. You want to look at historically how those have behaved. Okay, and then you can determine whether it's good or bad, right? Kind of a situation. Loan track records, verifying the financial strength of the company. You look at the balance sheet, compare cash and debt ratios and things of that nature, and debt to equity ratios. Okay, which stock has the highest dividend yield? Well, again, so if the prices are on the decline, it's still paying a dividend. That could have a high dividend yield percentage, but is that good or bad? Okay, so again, you got to be careful. You got to go beyond just the yield. It's not a one-stop shop for answers. Okay, and we're finishing up with this. It says many stocks pay dividends to reward the shareholders and to signal that they're on sound financial footing to the investing public. Again, in the investing public, if you can run your company privately, that's my advice. Okay, to the compliance and the legal regulations and all these other kinds of things. It's prohibitive. It's just very prohibitive. It's a measure of how companies' dividends are relative to how high companies' dividends are relative to its share price. High yielding dividend stocks can be a good buy for some value investors, but may also signal that a stock share price has recently fallen. We've read this story over and over again. The yield can suggest distributing too much profits. Yeah, we looked at all this stuff again. So really, dividends, equity price, equity value, yield, payout ratio, payout percentage. Okay. Now for the macro classes, this stability stuff, you're going to hear. So I have a real quick little piece on this, right, that we're going to go over now. Okay. Actually, this is financial stability there. This is we're going to look at equity and debt. Okay, and we're going to get to this in a bit. We're here today. This is 8, and we're going to get to equity and debt financing. Financial stability is about building a financial system that functions in good time or in bad, and can absorb all the good and bad things that happen in the economy, the U.S. economy or any economy, the European economy. It's about preventing failure or stopping people or businesses from making money or losing money. It is just helping to create conditions where the system keeps working effectively, even with such events, or even when the events are, somewhat unforeseen, kind of a thing, like the Greek debt crisis a number of years ago, and like a number of other sort of examples that are out there. The American economy is a dynamic, growing economy full of businesses that are starting to expanding, succeeding, and failing. The standard function of the normal business cycle. A financial system is stable when the financial institutions, the banks, the savings and loans, and the other financial products and services providers and financial markets are able to provide households, communities, and businesses with the resources, services, and products they need to invest, grow, and participate in a well-functioning economy. In other words, the financial system works as it's intended to work and as it's supposed to work, and provides the services and products and resources to keep the economy's moving and to keep the social system functioning is what that is. Loans, borrowing money, homes, cars, retirement, savings, pensions. Okay. So businesses have to expand, okay, build factories, hire new people, make payrolls. All right, this is all what the financial system does, and most people don't even think about it, and generally because it happens pretty automatically, at least in America. Consumers and businesses know that they can finance large expenses like the construction of a factory, or their savings are safe, or they'll be able to get short-term loans to make a payroll. The Federal Reserve defines or wants to work to identify any threats to stability and develop effective policies to address those threats through the Division of Financial Stability, monitors financial markets, institution structures, and also conducts research on financial stability issues. Okay, so just a little snippet of a little bit of what financial stability is. A good definition is it keeps the financial system working as it's intended to work and as you expect it to work. Again, remember sentiment, consumer sentiment, and confidence, and expectation, and forecasting, and all that other kind of a thing. Right? Sentiment, confidence, expectations. Right? We talked about those recently. So now we're going to add financial stability to that. So for the macro audience out there, that's a good. So we're jumping to a bunch of different topics, and finally today. So today this was like sort of a bookkeeping day to sort of finish up what's going on. Warren Buffett loves this return on invested capital. So actually, what we're going to do. So this is 70. Yeah, we're going to do equity and debt fund, not tonight, but we're going to do equity and debt financing next time. And just sort of go through the pros and cons of all of this. And this is almost like, and we worked on this. I was toggling to this other piece here because we were working on this in class also. We looked under Musk and whatever video it's in, you have to go find it. We pulled out current portion of debt, current debt and finance leases, net current of portion. So we pulled out Musk's debt numbers plus his equity. Okay, but the guy's returning, if you look at the profit here, the accounting profit is about 12 billion. It's not the 17, the EBITDA or whatever. It's, to keep a uniform sort of comparison among all these companies, we use the accounting net profit. I generally use net accounting profit and loss all the time. It's that kind of a number. And now, as you're looking for, trying to, turning over a stone to find an investment, you may be looking at some other measures, but the accounting profit and loss for me has worked pretty well. The guy's doing, 12 billion this year for the electric car maker, and the equity is about 44, and the debt is about the debt number. It's about another 3 billion, so it's like 47. So it's about a third, a half. Whatever. So what do we get out of this thing? And we did. Now I subtracted out. I subtracted out cash and short term. That's why it's so much higher. In class, I may not have done that, but I subtracted out the cash and the short term investments, and then added equity and the two debt pieces. The 3 billion in debt, so 47. That's why it's so high. Okay, and also what we can do is let's check this. Let's do Tesla. You're netting out from cash, is what that is. This is return on investment, but it's not the same thing. Yeah, this is ROI. That's not what I computed. So all right, they're saying 29%. So and again, now if we subtracted out cash here, then that could have been a part of it. So let's do this without that. Yeah, now you have 26. So they did it without the cash subtract out. It was just debt over at that 29, right? And what did we find online here? Right, whatever this was, 29. We got 26 or thereabouts. Okay, so depending on the year or whatever, a little bit of movement and change. But I may have observed that in the what they're talking about here. So anyway, return on invested capital. Assess a company's efficiency at allocating the capital under its control to profitable investments. ROIC gives a sense of how the company's using its capital to generate profits. I like that. That's really the definition. Whoops. Comparing companies' return on invested capital with the weighted average cost, whether the invested capital is being used effectively or not. So in other words, this is, again, as it says, so weighted average cost of capital, it just simply, it's the cost of debt and your opportunity cost for your equity. And those two percentages could be the same. And if you're 50% debt, 50% equity, that's how you're weighting it. It's 50% weights of each. Or if it's just, a simpler way to do it is just all the capital that's in there, and the opportunity cost is times the, whatever the return is on the 10-year treasury or something. You can do it like that. Generally, though, that's a very simplified version. The weighted average, you're going to have a debt part and an equity part with different returns for equity and debt, and you got to compute it that way on the weighted average cost basis. But we're not necessarily going to worry about that right now. Okay. It says ROIC is the amount of money a company makes that is above the average cost it pays for debt and equity capital. Okay, well, that kind of we just said. So, numbering. It can be used as a benchmark for the companies. And you saw I just ran through and found the Tesla version online of this. So, and again, not that what I did was wrong, but I get to compare how other people define return on invested capital. I netted out the cash, which is maybe a liquidation move a bit, but because I've been doing a lot of that work lately, so maybe that could be it. So, okay, formula. This is invested capital, net operating profit after taxes. That might be another version of that. After taxes, income minus dividends. He's not paying any, divided by debt plus equity. Yeah, this is how the version we found online. This is what they did. The denominator is the total capital, debt and equity summations. There's several ways to calculate the value. You can subtract cash and non-interest-bearing current liabilities, including tax liabilities and accounts payable, as long as these are not subject to interest or fees, from total assets. Yeah, this is the tough way to do it. The best way is this way. The second way is subtracting cash and non-interest-bearing current liabilities, including tax liabilities and accounts payable, as long as these are not subject to interest or fees, from total assets. Okay, that might be another way to hit it. How much accounts payable does our guy have there? Yeah, we don't have that here. We don't have the balance statement here, or the balance sheet here. Okay, I'm sure that's something. Another way is calculating invested capital. So yeah, so we're trying to figure out how to compute invested capital. That's really what we're trying to compute here. And the book value of the company's equity to the book value of the debt, and then subtract non-operating assets, including cash and equivalents, marketable securities, and assets of discontinued operations. Book value of equity, the book of debt, and then subtract out cash and equivalents and securities. It's another way to do it. The number 2 and 3 are very tough ways to do it. The last way is obtain a working capital figure by subtracting current liabilities from assets, and then non-cash working capital by subtracting cash, right? And non-cash working capital is added to the company's fixed asset. That's, you're really, instead of just taking the debt and equity numbers like I did. So those are all, yeah. Denominator is the total capital. Those are all the tough way to do it. But it's we could do them, but I picked the more straightforward version of this. A healthy growing company has a higher ROIC. And a lower one suggests an unsustainable business model. The value in the numerator can be calculated in a couple different ways. Subtract dividends from income. It's really the accounting earnings is really what it is. It could be, if there's one-time benefits, you got to sort of compensate for that. Foreign exchange rate fluctuations. But now you're getting to the comprehensive income part. Net operating profit after taxes. You take the operating profit times 1 minus the effective rate. That's another way to do it. Okay. Let's see. What do we get when we do that? We get about 13 billion from this. And what are we going to do here? Copy, paste. How am I doing this? This is equal to this times 1 minus the effective tax rate. Yeah, it's about the same number. Okay, it's about the same number. So not very different, right? Almost identical. This is very close, right? Net operating profit margin after taxes. So you're not including this interest income stuff and the debt numbers and the taxes. You're not including all that stuff. Okay, that's another way to do it. Report the effective tax rate for the quarter and earnings release, but all companies do this. So, yeah, you can do tax expense. That's what we do to get the effective tax rate. That's how we do it. We take the tax expense divided by the income, net income, work it like that. This is always calculated as a percentage, trailing 12 months or annualized, compared to the cost of capital to determine whether the company's creating value or not. And we'll spend some time with weighted average cost of capital too. If this is greater than the cost of capital, the most commonly used cost of capital metric, values being created in the firms will trade at a premium, a common benchmark. So this is the whole opportunity cost argument here. We're comparing this to sort of what we could do someplace else and that kind of a thing. A common benchmark for evidence of value creation is a return of 2 percentage points above the firm's cost of capital. Some firms run a zero return level, and they may not be destroying value, but they have no excess capital to invest in future growth. That's very theoretical to think that way. It's an important and informative metric to calculate. It's more important that for some sectors than others. High capital industries, semiconductor manufacturing, oil exploration. These guys have equipment. So you care about this. Some of the limitations. It doesn't tell you about the segment of the business is generating value. If you make your calculation based on net income instead of net operating profit after taxes, the result can be even a little bit opaque. So yeah, all of these sort of, again, if you always just go back to understanding what's going on in the financial statements, I'm not saying you don't need these ratios, but if you had a choice between understanding two things, I'd want to understand the income statements and balance sheets and cash flow statements as opposed to all of these ratios. Okay. There can be non-recurring events that sort of cloud all this, and you got to understand that. Price to earnings. You want to look at ROIC really, and Buffett would care a lot about price to earnings. He would care a lot about that. Okay. So maybe both of those, you take a good look. And Musk is way up there. It's way past the just what the S&P 500 does. It might suggest the company's oversold, or it's speculative, right? Or no longer generating value for the shareholders. But if you have high returns of ROIC and the price per earnings ratio is maybe not that high, that's a value. If PE is high, then the market recognizes the return on invested capital they're getting out of this particular company. This is Target does one of these. Did we do it here? I'm trying to see if and when we work that out somewhere. See Target. Guys, give me a second. Sorry for the yawning. That's some Warren Buffett. All right, I guess we didn't do it then. Okay. But there's an example in Target to sort of deal with this. Operating income, then gets EBIT, added back, income taxes subtracted. Fine, okay. That's a capital, shareholder equity, long-term debt, operating lease. Yeah, here's how you get the invested capital. It says it right there. That's what we did with Tesla. Now, Tesla subtracts cash and cash equivalents where or Target does. And I don't know. If we did that with Tesla, you got that big percentage is what you got with that. Right? So that's why you have to just know, you have to know what makes up your financial statements. And if, some companies might subtract it out, some companies may not. And I don't know if there's any real guidelines out there that say, hey, you can't do this, you can't do that. These ratios, it's the Wild West with these ratios, to be very honest with you, because you could see if you subtract out the cash, you're going to make that denominator, kind of small, and you're going to make the denominator kind of small and end up with a bigger maybe return on invested capital than otherwise is warranted. It makes sense to me because the idea is the cash is just sitting there. That's why it's subtracted out, and it's not really active in the company. But Anyway, so what's invested capital? Money raised by the company to issue securities or to some company's equity, debt, capital lease obligations. It's not a line item in the company statements because debt, capital leases are each listed separately in the balance sheet. Sure. Okay, so again, understanding what that is, number one. Issuing securities. Okay. And return determines how effectively or how efficiently the company puts the capital under its control towards profitable investments. Yeah. It gives a sense of how well the company is using the money it raised to generate returns. The return with the weighted average cost of capital reveals whether the invested capital is being used effectively. We'll hit the weighted average cost of capital thing. We'll do that at some point. Yeah, here it is. It's this thing. Yeah, it's equity to debt, return for equity, return to debt, and then the tax rate. What's left after tax? With pulling the taxes out of that. Okay, so that's but we're not really hitting that today. So let's just one thing at a time here, and the formula net operating profits divided by invested capital. With a steady or improving return are unlikely to put significant amounts of new capital to work. Okay, so in other words, what you're getting out of what you invested in the company. Okay, so there it is, folks. So we talked about also for this week, September 25th, Monday's YouTube day. Wednesday, the morning classes don't meet. So my 10 o'clock and my 11 o'clock only meet. My 9 and my 10 o'clock only meet once on Thursday. And my afternoons, my 1 o'clock and my 2 o'clock on the 27th and 20th are normal. And NJCU is normal too. Okay. Tuesday, Thursday at 4:30. Okay. All right, folks. That's it. Thank you.